So we'll talk about some of our best and worst investment decisions, and I know John's got some comments on that, but maybe to start off, I know, Michael, you had some, oh, sorry, not Michael, Michel. Michel, sorry.
Yep.
You had some comments on the state of the M&A market.
Well, look, so I guess the business
Might join you over here.
Yeah,
sure.
Definitely, make it a bit more casual. So I work with a business called Flagstaff Partners. We're what's known as a boutique financial advisor. That really means that we predominantly provide M&A advice to our clients. We don't have all the bells and whistles that come with the integrated banks, and we're really just focused on purely the advice side of the business. The business has been going for about 10 years, and I'm one of 5 partners. Most of my time's in the resources energy space. So we do lots of different things. So we sort of see the full spectrum of the transactional activity. I guess in M&A, generally speaking, we've been involved in 2 large transactions that have completed in the last 2 years that I can talk about. The problem with our business, as you know, is we're always working on a lot of things that aren't public. And I guess what we saw there, 2 of them were really the mineral deposits takeover by Mamet. So it was about a $650 million hostile takeover, which is pretty unusual to see a hostile takeover play out in the marketplace. And that came about for a whole variety of specific reasons. And the second situation, we were advising the Lattice Energy board on their attempted IPO. They're running a dual-track process where they're looking to either sell the company or IPO. And this is kind of interesting because it ties into a few of the themes that you picked up on. And I'd say at a very high level in the M&A markets, what we have seen is in the last couple of years, we've seen the resources companies come through sort of a world of pain and rationalize and take cost out of their businesses. And as a consequence, tighten up capital allocation. And so that has meant that M&A activity dried up, and we saw the beginnings of M&A activity focus on the deals that should happen, so the logical deals. So a good example would have been this mineral deposits deal that we're involved in. Joint venture partner owned 50% of the project. They had a high level of information asymmetry around the project relative to the listed investors, you would say. And they had a logical reason to own the business, being a 50% partner, having a longer-term view on the overall project. So those type of deals started happening a couple of years ago. And then I think as the market has continued to strengthen, commodity price-wise, we've seen the level of risk tolerance increase. And we've seen people becoming more adventurous in the type of deals that they've been looking at doing. And so I think that's sort of morphed into the deals that had to happen, into the deals that can happen. Partly because people have a lot more access to capital, partly because they're becoming a bit more aggressive in terms of their risk tolerance. And I think you see lots of different trends emerging there, whether it's the large caps recognizing they can't play in the exploration space, they're taking cornerstone investments or strategic investments, or other forms. So I think we're just seeing sort of an evolution of risk tolerance basically just play out in the M&A market as a very high level comment on sort of how it's progressed.
Well, as I said earlier, with Barrick and Randgold coming together to create the biggest gold company in the world to become more relevant to the market, it sort of sends a signal right the way down the chain that bigger is potentially better. And a lot of the bigger companies, we've seen Resolute is a good example. They've taken a 20% stake in 6 juniors as a deliberate strategy, essentially to help fund. But I guess they like the projects. They're spreading their risk, but it's getting their foot on juniors, funding them so they can eventually take them out. But it's just with the scale of the market, and if you look at say Silver Lake and a Doré coming together, 150 and 300 mil. There are standouts in the mid-tier that probably can bulk up, but there are so many juniors with a 10, 20 mil, 30 mil market cap. The gap for them is just enormous. I don't know how.
Yeah, I suspect it ties into one of the points you made earlier around, I think the smaller end of the market's going to find it quite difficult, generally speaking. I share your view, probably disagree with some of the others in the room, but I think there's been a structural change in the market. I think, we've had consolidation on the buy side of all the infrastructure funds. So if you think of the industry funds, all these industry funds are getting bigger and bigger and bigger. And that's creating a concentration of ownership on the buy side and to different degrees of sophistication. You've had reforms in the research space. So MiFID, for example, has created a disconnect in the equity research space. So less sophisticated research analysts, less experience, and less interest covering the smaller players, less risk tolerance in the mining sector for various reasons. ETFs and the like, cost out, productivity commission drivers. So I think all of these things have come together and they've effectively reduced the capital that's available for developers, I'd say for smaller companies, and I think that continues. Sorry,
John?
It's interesting you're talking about mineral deposits and a 50-50 joint venture partner making a takeover.
Yeah.
Gold Road and Goldfields actually went the other way, and I think it's because Gold Road became so richly valued. I won't say overvalued. Became so richly valued that the 50, Goldfields had a stake in Gold Road, and they sold it out just about a month ago, because I think because the share price was so high, they just thought, well, look, we do know the information about the project, we know what the NPV value is, and possibly they saw it as being over that value. And they sold it out. So I think the gold space and those mid tiers who get into that $500 million plus, Gold Road is about $1 billion, I think. They get to the point where perhaps it's prohibitive for M&A to occur with them. The other one you mentioned, Resolute being having shareholdings in 6 different juniors. But we actually saw them make a takeover bid for Toro Gold, which is a private company, which they didn't have a shareholding in.
Yeah.
So, we've seen Northern Star make a bid for Echo, which they obviously have a major stake in. But similarly with the St Barbara and Atlantic Gold, St Barbara have a number of shareholdings in Peel and Catalyst in Victoria, for example. But they went overseas to Nova Scotia and made a takeover bid for Atlantic Gold, which they didn't have a shareholding in. So if people are looking for where the mid to large tiers are going to go, it's not necessarily a good guide that their existing shareholdings. They may raise their sights.
If you think about it, John, just taking a shareholding in a company, all you're doing is you're really putting your foot on that vehicle, right? So if I'm the acquirer and I've taken a 10 or 20% shareholding, it effectively gives me a seat at the table. Usually it'll come with board rights and a series of shareholder protections, but it's almost it's just putting a foot on the opportunity, and you do that in a way to allow that company to keep de-risking the opportunity, so that you can acquire it when you're more comfortable with the opportunity. So it doesn't necessarily, back to your question about, does that mean they'll take them over in the near term? Well, the time horizon is the big question, right? If people get comfortable with the risk and the quality of the asset, and if it is de-risked sufficiently, then ultimately the conclusion's fairly obvious.
Yeah.
But it's the time horizon that's the big question, I guess, if you're an investor trying to work this out.
Yeah.
So the Gold Road deal was, I know it was a little controversial at the time. It was a single asset company. They'd gone, their market cap, I think, had got up to $600-700 million, and they were looking at a standalone financing, yet they gave a 50% interest in the project, or I think 50-51 to Goldfields of South Africa. And then since then, we've had a lot of companies, a lot of the juniors in the gold space that have tried to take assets and develop them, go into production, have come to blows or fallen over. So it's a different skill set, and in terms of taking yourself as a single asset group, the joint venture model, I think, is a very good one. In my lifetime, we fund a lot of projects, and we get tension between how Australians go about funding projects versus the Canadians. And I find the Canadians tend to try and make things bigger and bigger and bigger, and they assume that the access to capital is always there. That as long as they can get the biggest NPV, they'll solve for the biggest NPV. Well, I think the Australian attitude is, well, we might have a massive NPV, but we've got to fund it. So in fact, there might be a pitch shell or a lower NPV that we can still fund with project financing and a bit of equity, and we might then bootstrap our way up there, rather than trying to raise $1 billion when we've got a 100 mil market cap. So I don't know whether you've seen, but we've copped that a number of times from the Canadians saying, why have you started to develop this mine before you know how big it's going to be? And it's because, well, you've got to access the capital markets, and maybe on a smaller scale and bootstrapping your way up there makes a lot more sense than trying to raise $1 billion.
Yeah, absolutely. If you take your typical debt equity ratio for a development of say 60-40, and you're a for example, you're a $100 million market cap and you've got a $200 million capex and you've got to raise 80. Well, yeah, that is doable, but there's an inflection point there where the market starts to not believe that it's going to happen, and then you get into a vicious spiral, and the market doesn't believe it, then the share price goes down, then it's less likely to happen, and it just keeps on going. Whereas the market believes you can raise that capital, then you'll get into a virtuous spiral, and your share price will rise.
Absolutely, absolutely. Now, if there's a question from the audience, I'll span out from time to time. Just put your hand up and we'll happily take a question on anything that we've discussed so far. Oh, there's a question over there. Thank you.
Hi, everyone. My name is Charlie. I noticed that you talked a lot about gold, especially. Would you expect the same pattern to be happening to other minerals, especially, for example, critical minerals or rare earth metals? Or are there any other considerations in driving the sort of capital market for those minerals?
Are you referring to M&A specifically?
M&A and financing of the project.
I think just one comment from me would be, I've noticed just anecdotally that probably over the last 18 months there was a lot more M&A in non-gold sectors such as mineral sands and also copper. We probably saw at least 4 different copper takeovers in the junior space. I'm not talking about the big boys like Randgold, etc. But in the last probably 6 months we've started to see almost on a weekly basis new M&A deals being announced in the gold space. So I think we're definitely, with the rise in the gold price, we're definitely seeing a lot more activity in the gold sector.
Michel?
Yeah, look, so I think on the gold side, I think there are a couple of things that are driving that. One, you've got tailwind and high prices, right? And clearly a real concern at a macro environment in terms of where the global interest rate setting is at and where it's going. So that provides a huge amount of tailwinds. And then secondly, companies are building up a large amount of excess cash, right? And they're not used to having this excess cash, and it creates a sort of a opportunity in terms of where they can allocate that cash. And so that creates very ripe conditions for M&A activity. I think in other sectors, look, I've spent a lot of time in the mineral sands sector in the last 3 years. And so I've been very close to that, and a lot of time in the oil and gas sector. So I probably can't cover every subset there, but each of the industries tend to have their own drivers. So in the mineral sands space, for example, it's a highly concentrated sector. You've got a small amount of producers, and you've got the small amount of pigment developers, small universe, very opaque market, very difficult market to strike off-take contracts in. And so naturally the opportunities, there's large distortions in pricing of assets that occur over time. And that creates unique situations for particular buyers in that market. So it's quite specific. And in oil and gas, again, it's just there's consolidation thematic playing out. Back to one of your points about bigger is better. There's a degree of truth in that in below the sort of $2 billion range in Australia for a whole variety of reasons. And there's a scale game that's being played out in Australia around that sector.
So I agree entirely. So I do think bigger is better, but I don't think it's bigger paying the 30% takeover premium. Yeah. I think historically that's destroyed a lot of shareholder value, but having the maturity of 2 boards of directors to come together at a nil premium deal or a very modest premium and then let the market decide. So I think bigger is better. I think you'll see more mergers and acquisitions, but I'm not necessarily a fan of the 30% premium unless you've got a producer taking a developer or a developer taking an explorer. But like for like, there's less of an argument for a big takeover premium. And in the gold, sorry, go ahead. Okay, and in the gold space, you've got such high values by the bigger gold companies that you've seen cash deals. So the Echo deal is pretty much a cash deal, because there's an argument saying that because people are trading at 1.5 to maybe 2 times their NAV, if they go to an expert's report and they start looking at the underlying value behind some of the bigger players, will they be able to withstand the scrutiny? While if a cash bid, you don't need an expert report, cash is cash. So it's interesting to see. whether are big guys, because I think they've just been, the valuations have picked up so high so quickly, courtesy a lot of these ETFs.
Yeah.
Now, moving on to
There's a couple of
sorry,
questions there.
great. Sorry, Barry. Thanks.
I don't know if you've been listening to the comments from Mark Bristow recently. I've found that he's one of the most impressive people in the mining industry. I've been following him for 10 years or so, and he's done some outstanding things. But bringing Barrick and Randgold together, it's a huge culture change within that organisation, and he's been saying basically you need to be big to be relevant amongst these big fund managers that you're talking about. But after we look at Newmont and Goldcorp, you've got a huge chasm, and I just can't see how we're going to bring a lot of those other companies together from disparate operations and make something big of them. I mean, I can't see a consolidation in Australia, let's say, of Northern Star and Evolution, because they've got totally different strategies, totally different operations, and I just don't know how we can have the consolidation to get bigger and bigger things, and it's also so important to ensure that the managers of the operations are really committed. Otherwise, we end up with BHP type portfolio management and no commitment from the managers.
While I was over in... Sorry, Barry, have you finished?
I was just wondering your sort of comments on Mark Bristow and some of his other comments.
Well, it's the world according to Mark Bristow. He's done an unbelievable job, and he's a supremely confident individual. For Randgold to take out Barrick, and then to have the Barrick CEO become sort of chairman. But it's essentially Randgold running the show, or it's all Mark Bristow's troops that are running it. He's a visionary. He's an elder statesman, and he's done a fantastic job. And when I was over at Beaver Creek recently, a lot of the Canadians were saying there must be a dozen of sort of mid-tier Canadian companies that need to follow suit, that need to come together. So it really had created a lot of impetus there. Probably we've got three. What have we got? Saracen, Evolution, Northern Star. Possibly Silver Lake and Westgold, probably missed them, maybe Ramelius, but we don't have the large number that they have over in North America. In North America, there's probably 10 to 20 of them, and it makes more sense for some of those with Mexican assets to come together. Probably less relevance here.
But would they come up with 10 and $15 billion consolidated companies? Because Mark's talking about 40 billion to be relevant, and I just can't see how outside of Newmont Goldcorp and
where they get that.
Randgold, it just doesn't make sense.
Well, I don't know whether Mark's just trying to scare everyone else off and get everyone to invest in Barrick because they're the only ones who are going to win and everyone else is going to lose. I don't know.
It'd be interesting to hear the rationale for why bigger is better above, a certain range. I mean, in some sectors you'll make the case that bigger is better because you get better access to capital and you can fund bigger projects. Well, I'm not sure there are that many big projects to fund that are required at $40 billion, right? I just suspect that's not the case. In some sectors, you get bigger because by being bigger, you get to access, broaden out your reserve life or change the risk profile of your broader business. I suspect at some point it crosses over and you don't get those benefits. I'd love to hear the rationale for why $40 billion is better than 10. I don't know. I don't buy it.
It was also very interesting to listen to Northern Star and their strategies, their commitment to all this sort of social responsibility, because they're saying that so many of the big fund managers won't talk to you unless you've ticked all the boxes regarding all these social responsibilities, and that seemed to be far more important than market cap size.
Yeah, I think that's we didn't talk about that, but I think that's a very big change that's happening in the investor universe. I think if you talk to all the, bigger companies, the BHPs and the Oricas and the larger mining-oriented listed companies in Australia, they're finding a very big shift in investor appetite, moving or focusing on ESG issues. And I think that's going to ultimately mean over a period of time that you'll probably find that unless you're ticking all those boxes and you're addressing climate change issues, which I know you're not a big fan of, but all the traditional ESG parameters, I think you're going to find cost of capital will go up for companies that are not meeting those parameters. And it's probably one of the variables that's fed into why we've seen less capital flowing into the development space, I suspect, on the periphery.
Well, I was at a presentation, Peter Bradford spoke for Independence at the Mining Club during the week, and the first sort of 15 minutes of his presentation was all about, the social issues, the engagement with the staff, the climate change, they're moving into the green, they're into nickel, batteries and green technology, but there was and there were people from IGO around the table saying, we're aligned with this. And it's sort of the shift away from shareholder return to a lot of these sort of social issues that you not only want your shareholders, or some of the shareholders are looking for, but also the staff want to be part of it, to be engaged. As part of the millennials, I guess, want to be aligned. While back in our day, that was the last thing you were thinking of.
Well, it just makes your comments about these private companies all the more interesting as an alternative.
Yeah, absolutely. Well, it's huge, a huge market. Yeah. These alternative trading systems, I think, will end up dominating. I think the days of the ASX and the TSX, they need to come together. They're suffocating capital. Actually, there's more rules and regulations than ever before. To be listed on one of those exchanges now is tougher than it's ever been, and it's almost they're suffocating initiative. And there will be other markets will emerge, and an Uber-type event might be coming to them, where one of these alternative trading systems gets up, where you trade 24 hours a day. And you do have the regulatory compliance. A lot of these ATSs are compliant with the SEC, and the volumes going through now are really picking up. But it's sort of off the radar. As I said, we tend to look at the ASX, the TSX, Dow Jones, but there's only half the companies that were really on those indices there 10 years ago. So there's a big change happening.
Yeah. Look, I think the private capital market's going to continue to be a long-term trend. I think it's probably a bit harder in the resources space because I don't think we've had enough success in the private capital space in Australia. I think it's been quite hard going for a lot of the private equity funds. So until we break that, I suspect it probably the model's going to evolve. We're probably going to see other capital access opportunities. So streaming, we might see the development of a debt capital markets, greater depth there. We might see sort of other alternatives emerging before we really see private equity taking off, I guess, in the resources sector.
It's a really good comment, because I was chatting with a gentleman that was part of a private equity group, and he's in the audience, and he was saying, a private equity fund might have be a closed-end 10-year fund, and you think, well, 10 years is a long time, you should be able to get behind ResourceStocks, but it turns out, by the time you've got in, and if you've missed the timing or the window, it's just not long enough.
Well, that's why I think it's so important to recognise that 2011 downtrend in the gold sector and the 2008 downtrend in general resources has finally been broken, and that's we're talking about 8 to 11 years of bear market, and that's had a huge impact on sentiment, and that's why when I look at that sort of $1,580 billion of bank deposits, it basically it's really sentiment, and that is at the retail level, but it's also at the wholesale level. Very, very defensive portfolio strategies, and as I say, if I look at the equity markets, they're telling me that they want to go up, they want to go down. So there's going to be a change in sentiment, and flow in capital, given you've got $100 trillion tied up in the bond market. I think that can explain the cyclical changes that I'm expecting, and we've seen this secular decline during a 10-year cyclical bear market. It's had huge impact on allocation of capital and just participants in the marketplace. So I'm a great believer in animal spirits, and I was very pleased to see Scott Morrison talking about his defiant optimism, which I sort of subscribe to, but I think that's coming, because I think we're going to get through the next 6 months or so, and it'll be a different environment, and people will say, I don't want to be in cash anymore. I see all these bureaucracies setting up everywhere, whether it's the superannuation funds or APRA or whatever, and they're acting as impediments to the proper flow of capital. But at the end of the day, animal spirits, I think, will overcome all this. And that's what the gold price is telling me. That's what the iron ore price is telling me. And the copper price is knocking on the door to tell me the same thing.
Brilliant. I'm a big fan of animal spirits, but that might be a good segue into investment opportunities and looking at the funds management business that you're a director of. Can you enlighten the audience on maybe what Lowell's looking for and whether you can talk through some of your experiences?
Sure. So I'm a fund manager, one of the few remaining. I don't know if it's a dinosaur or not, but we are an active manager. We do focus on the junior resources space exclusively, mining and a bit of oil and gas as well. And generally, when I say junior, we're probably still talking about the sub $200 million market cap and guys who are generally pre-development. In the oil and gas space, we do hold some production shareholdings in companies that have production, but generally in the mining space, we're pre-development. And it's motherhood to say that you look for people and projects, but I think you'd also add a couple of other factors to that in particular that we might look at. One is timing. I think it might have been one of the companies earlier today said, making good announcements, last year was just an excuse for shareholders to, a liquidity event for people to sell. So if you might be investing in the best people and the best projects, but if you've got your timing wrong, then you're really swimming against the tide. And the other one I think that we've alluded to today is capital. That the capital to get a project into production needs to be achievable. Sorry, I should rephrase that. The market needs to believe that company can achieve it, and then it becomes almost a self-fulfilling prophecy. And obviously, the lower the capital, the lower the barrier to entry, the more likely it is that the market will believe that that project will be developed by that company. Or if you have a bigger capital hurdle, that company needs to convince the market that it has other funding avenues, joint ventures, offtake partners, etc., which will fill the capital gap.
So on that recent trip to the US, and I've had it a few times now, that and I mentioned it during my presentation, you need a 30% IRR, 3-year payback, and some relativity between your market cap and the capital that you need to raise. If you can tick those boxes, there was $25 billion sitting on the sidelines, US funds, pension money. They said, we can't deploy it. We're looking for, some of the high yield funds are looking to make 13 to 14 to 15%, and we can lend any volume of dollars out the door. But others, they're just saying, as long as the project's got a 30% IRR, 3-year payback, and there's not a craze, not 50 mil market cap trying to raise $1 billion isn't going to work. But maybe 100% of your market cap, maybe 200% of your market cap, but outside that, it's a bridge too far.
Yeah, and I think we're seeing that in the market. Back in the mid-2000s, there are a number of iron ore projects out there with capital. Maybe the magnetite projects with capital tickets in the billions. Being promoted by companies which might have had a pretty healthy market cap at that point. Maybe 500 million. But you're just not seeing anyone talk about those capital numbers in the junior space anymore. It's more let's 200 million, 500 million. There's not too many projects with a capital ticket over 500 million. And I think that gets back to what you were talking about with the Canadians. Is the Australian market very much tries to cut its cloth to have an achievable capital amount that will allow that company to get into production.
Which goes against corporate finance theory, where you're trying to maximise your NPV. But there's another component to that where no, you don't actually. You've actually got to come up and raise it in the market, and there might be a slightly suboptimal NPV, but it'll be a funding envelope that you can start and get into the market.
Yeah, and I think even today we've seen a number of gold projects which have had a stage, development, might be initial pitch shell or a stage 1 or whatever, which is achievable for those smaller market cap companies to raise the equity on, and then prove themselves to the market, and also generate some cash flow, and then they can go back to the market, do a refinancing, expand their financing, and raise some more equity.
Or possibly bring in a partner at the right time to both bring in upfront funding and to reduce the ongoing commitments. I suspect these small companies just need to be a bit more nimble in thinking about their alternatives if they've got this disproportionate capital position.
It's interesting to hear you talk about the Chinese joint venture. I'm assuming, though, that most of that interest is in existing operations or very near-term operations. It's, once again, you get that divergence between the haves and the have-nots, the guys who are in production or finance to production, and the guys who are still to make that leap. And definitely, most of the interest is in the existing producers.
Yeah, so the appetite is enormous. I think Barry was talking this morning about the Chinese production and Australian production on a per annum basis about to push through the Chinese level, and I think that's right. They've recognised that. Yeah, I've got a question over there. Got it? Just a moment. And the Australian production is about to push through, so the Chinese recognise that they've got limited opportunities in China, and they're very keen to find Australian opportunities, but you've either got to be in production or got to have a clear pathway to production. So grassroots exploration, possibly not, but something more advanced. But they wouldn't rule out taking equity, so we're keen to try and kick a couple of goals there and see if we can open up more avenues for cash. Yes, sir. Oh, madam.
Hi.
Sorry.
Sorry. I'm Sue Wade. I just want to ask, you talk about financing and all that. Why are the banks or the lenders charging such high interest rate? I heard about 12 or 13% for a mining project when interest rates are going negative in Europe and Australia sounds like we're going to zero. So what's the justification for charging such exorbitant rates?
The easy answer is because they can get away with it. But sorry, I should say generally it's not the traditional banks who are charging those rates. It's debt funds who generally are prepared to push the envelope a bit more in terms of the amount of debt. Well, the debt to equity ratio would be higher, and they might look at financing a project without requiring any hedging, and they might finance a project where there's no terminal market and you can't hedge. So certainly they're taking more risks, and it's the interest rate that they're charging is a function of what they're telling their investors their mandate is. That typically these guys would go and tell their investors, we're going to be able to return to you north of 8 or 10%, and that's their mandate to go out there and find opportunities like that.
All right, so for the banks, do you think there'll be much lower interest rates?
Yeah, that's my experience, that the banks might be in the sort of 5 to 8% range, which is typically a lot lower. But you generally would not be able to raise as much debt from a traditional bank.
And it depends on the terms of the financing as well and the market that you're in. So if you're in a really niche part of the market, a specific sector that just isn't attracting bank financing,
gold mining.
well, that's difficult. It's different. And likewise, if you don't want to live with the covenants and the onerous reporting and governance obligations that come with bank financing, you're trading things off, right? So it's cost versus obviously the governance requirements that come with it.
Yeah, so standard bank project financing for a good gold project, you might be able to get 60% gearing. So if the capital was 100 mil, you might be able to get 60 mil worth of bank debt or thereabouts, and that would be a bank bill's rate plus a 1.5% margin. I don't know, 2% margin.
Yeah, maybe 3 or 4, but yeah.
Maybe 3 or 4. So your total interest rate might be 5, 6%.
Yeah.
Upfront fees and hedging obligations on top of that, though.
Yeah,
right?
yeah.
So you've got to load it up a bit.
Yeah, and there's an extra return on the hedging. So the bank market might be around 6%, plus you've got some hedging, which might gross it up to probably 8 or 9%. But the baseline for the debt might be 6%. But that's for 60% gearing. But you might have another fund which comes out of one of these debt funds will say, how are you going to raise your equity? And equity is quite dilutive. You've got a low market price, low market capital. So why don't we'll gear you 70%, 75%, but we're actually going to charge you 13%. And when you look at your cost of equity versus the cost of debt and maybe the covenants that go with it, there's often a case. But having said that, the ones that they had the best interest in was the graphite and the lithium market. So where you don't have a terminal market, so you can't hedge it, so it's not gold or copper, they're prepared to take that punt, and they're essentially taking equity risk, mezzanine risk. But in terms of a gold project, if it's any good, it should be your base rate should be, what do you think, 6%?
Yep.
Sounds reasonable.
There we go. Thank you. Question at the front there.
I've got one
I'm
here.
sorry, another one?
Kingsley Jones here. Look, I think it was Liam mentioned the streaming market, and I'm just interested in the context of these financing questions. We often have projects that are in the neighbourhood of one another with a plant that might be able to process, and people generally are doing deals where they might buy someone close to them to keep a plant operating. So I'm just interested in the scope to reuse some of this equipment and so on, as is happening naturally, maybe through some novel financing mechanisms like streaming, where you don't actually need to buy your neighbour or stuff like that, as a way to get some of these smaller projects up and running. What's your view on that? Is there scope to increase capital efficiency by doing creative deals rather than just buying each other?
The cost of funds with a streaming deal, it's very expensive. I mean, it's probably up around 30%. So you've got your cost of debt, your cost of high yield debt, your cost of equity. But if you can't raise equity, and the cost of equity is infinite, so there might be a room for a stream. But the issue with a stream, if you can't suck out too much value that you then can't get your project into production or afford any normal debt. So streaming is expensive. It depends, and the North Americans tend to look for stream or royalty financing when you're at a decision to mine. So you've done your bankable feasibility study, and they might take a little mezzanine component with a stream. But the new streams, and part of what Future Gold's looking to do, is actually get you from a scoping study to a decision to mine, and maybe taking 50,000 ounces out of a million ounce resource. So we're taking sort of mezzanine risk or equity risk, but trying to jump the gun of the current royalty models that we see over in North America. But look, streaming it needs to be in your arsenal. If it's available, if there's a resource there, maybe you should look at as an avenue for capital, but it ain't cheap. Sorry, yes, sir.
My name is Arnie Getz. I look at nickel sulfide and copper every day, and we're talking about financing and limitations of financing. There are about approximately 100 megafactories, so they say, to build battery metals. They need, sulfide, nickel, copper, and the automobile companies have a different culture. They're used to just in time, meaning they don't really worry about where it comes from. And they have no idea, or I would say no idea, but they just take it for granted that these minerals, particularly nickel and copper, will be there. And we're talking about mega factories that going to need a lot of, particularly a lot of nickel. And the LME only has about 150,000 tons. I follow that every day. And so my point is a lot of potential financing will come from automobile companies, because the numbers are just astronomical. Like Volkswagen, they're talking about $50 billion for just battery materials. So my point is how would you put that in the mix? In other words, you're a developer, miner. How do you tap into this automobile financing? I mean, I think it's going to be desperate. I think nickel will go to $20 a pound, and copper will go to $6 a pound. It's done it before, because we're talking, the EVs are real. And legislation around the world is outlawing, ICEs. And, they just can't be casual about it. I look for explorers. I'm a frontier explorer. I'm not worried about developers, because also yes, we're going into negative rates, and there's a lot of pessimism. I see that on YouTube every day. That's my routine. But there is a lot of money out there from the big companies, some of the companies you mentioned, and there'll be a lot of takeovers because there's going to be a desperate play to get potential supply. And there has not been any new global nickel exploration. It's just taking from the old. And when you add in the political mix, like say at Norilsk, maybe there's a smelter that goes down. You know, the whole numbers change. So that's my question. Have you thought about finance from users and users like automobile companies?
I think there definitely is some interest from automobile manufacturers in financing battery metals, particularly lithium and nickel. We've generally seen it come out of Asia though. The European automakers may be moving in that direction, but we certainly haven't seen any direct, that I know of, investments by European car makers into mining companies. We've seen it out of Japan, we've seen it out of China. Think about Orocobre, for example, and there've been a number of other investments. But you know, the Western automakers have been really reluctant, and it's more just, okay, bring me the metal, and then I might sign a contract with you. So I guess, you know, in that respect, it may be short term. You know, we do, you know, like the fundamentals for nickel. If the EV adoption really takes off and the nickel ratio in the lithium-ion batteries moves to that 8:1:1 that people are talking about, there are risks to that still. And in the short term, we may see you know, nickel price retreat somewhat. There's certainly a bit of a glut of stainless steel, which is still by far the biggest use of nickel globally. There's a glut of stainless steel in China, so we may see the nickel price come off further before we you know, see those you know, those sort of prices of $6 a pound copper and, you know, $50,000 a tonne nickel again. So yeah, look, you know, automakers, they're quite entrenched in their ways, and they're real show-me guys. So I wouldn't expect a lot of money to be coming from them in the near term.
Well, ladies and gentlemen, I think we're at our allocated time. Are there any more questions out there? Well, if not, please put your hands together for Michel and John.